After 8 years of trading, there's almost no strategy that works without these two essential concepts, including your own setup. And once you understand them, you can actually make your own trading plan, and that's what I'll show you at the end of this video. So let's start. Now, the first question you might have is why these two? And the reason is very simple and it might shock you. And it is that every strategy you know is actually based on them, but you don't usually see it, or maybe they don't show you. They make you think that there is some secret behind it, but the reality is these two concepts. Now, before we go into the first concept, I want you to, and this is a task for you, so take it seriously, pick 1 to 2 key levels. And these are going to be used for the trading plan at the end of the video. So we'll be having a full trading plan based on the two concepts and then the key level that you will be picking from here. So you could apply it yourself, or I'll be picking some levels here. You would know which ones. Now you could go with an imbalance, an order block, support resistance. Most of these, they work the same. You could also do volume profiles and even things like engulfing candles, as simple as this. Actually, anything. Now, the first thing is market structure, and it comes in different shapes and different formations. There are only two things that we need to understand about market structure. And the first thing is continuation. And when I say continuation, that means we need to see strength and we need to see breakout structure. Continuation means that if price is going higher, I want to see it continuing higher. And as simple as this, if we can see that we do take this low and then we actually close below it aggressively, and then we go higher, we retrace higher, and we have strong bodies closing below, that is a continuation. So what we expect after is retracement and then continuation, another strength. That is what continuation and breakout structure is. The opposite of breakout structure is a reversal, and it's a market structure shift or weakness. Now, strength is closing aggressively, weakness is failing to close, or maybe closing one candle and then reversing. And imagine that we're going lower, but at some point we might be reversing and the weakness starts here. That is what a market structure shift is. So take a look at this. We have the breakout structure continuing lower, and then we create a low, we go higher. Now what we're expecting is another breakout structure for continuation. What happened though is failing to close below. And I've actually talked a lot about this here as the first sign of reversal, but notice what happened after. We have some weakness, and even if we close below, what happened after is closing above the last high that caused this. Now what happened here is as we're going lower, we actually shift the structure now going higher. So we moved from having lower highs to now going higher, and then probably creating a higher high and then a higher low here. So now the structure is shifting higher. Now what are we expecting? Because now we do have a continuation here, we're expecting another continuation to the upside. Now this concept for me is one of the most important ones. The reason is that the moment you can identify that breakout structure or market structure shift, so for example here, then I have a valid range that I can trade based on. So what this gives me is an invalidation, a clear one, which is the stop loss, and then a target, a take profit, and a key level to enter from, which is gonna be in between these 2 points. So basically what you have is a full trading plan. However, this thing does not work without the second concept. One thing before we continue, if you want to trade like me, access my trading strategy that I put together after 8 years of trading. I can give you high reward of best trades, and you want to trade with me, check out Edge School. The link is in the description. Let's continue. And that's the problem most of the people have, is that they teach market structure, but without the concept too, that almost any strategy and not just a market structure will not work without it. So I'll show you how to blend the two, and then stay tuned at the end so I can show you the full trading plan and you can actually create one yourself. Now, as I said, not only that one is not going to work, the market structure, but also smart money concepts is not going to work. Market structure itself is not going to work. Chart patterns is not going to work. Fibonacci and all of the different strategies that you're using, without this one concept, it's not going to work. And even if you just stay for this one, understand it and apply it to your own setup, you actually learn something from this video. So what is it? It's time frame alignment or top-down analysis. And it's basically you're analyzing the chart based on multiple time frames. These could be 3 time frames, it could be 2 time frames, depending on your trading style. And I'll show you both of them. So simply what we're trying to do is take a look at the big picture and trade based on the small picture, or do the opposite. Based on the small picture, I will look at the big picture in order to validate the small picture. And for me, this is one of the most important concepts ever. The moment you apply this, you have an automatic bias, a higher reward to risk? Simply, you could go from 2 to 1 to 5 to 1 just by applying this simple concept. Now you already know the key level that you picked. Even if you trade, for example, anything, order block, fair value gaps, anything, you remember that one, and you need to also remember the type of trading that you want to focus on. So are you more of a swing trader? Are you more of a day trading or scalping? You want to pick one of these combination of time frames based on the trading style that you prefer. So for example, we could do a higher time frame of 4 hour with 15 minutes, or you could do a daily with 1 hour. So simply a combination that fits your trading style, your availability, and the way you would like to trade the market. Simply what we're looking for is a higher time frame key level. This could be, for example, a 4 hour level. And then we're switching to the lower time frame whenever price comes here. And I'll show you how. So this high time frame level, again, could be anything, even a moving average. And then we're looking for the low time frame. The moment you understand this, you already have an edge in the market. All right, so whatever key level that you picked at the beginning of the video, I want you to do the same thing that I'm doing right now, but with your own key level. I'll be using the easiest key level that I could ever use, or not complicated, just to prove that you can actually do this yourself. The more mastery, the more repetition you put, the better results that you're gonna get. So, but simply the key level is gonna be an engulfing candle. So for example, we do have, let's think this is a bullish candle, then a bearish candle comes and engulfs the previous one. It could be in 1 or 2 candles. Now, one more thing is that you can use 3 time frames or 2 time frames for the time frame alignment, and the difference is gonna be for the 3 time frames, you add 1 higher time frame to the left. So if I'm using 4 hour 15 minute, this is gonna be my key level. The 4 hour 15 minute is my confirmation. But then another thing to confirm the direction and make it even better is to add a weekly. And now you have 3 time frames. So notice what happened here, and keep it as simple as this. Notice what happened. If I can see that, for example, price is reacting off a weekly, you have another alignment, but in this case, this is what I'm seeing, is that we do have an engulfing candle, and we have some weakness at the top. So we have weakness, failing to displace, and then going lower. Engulfing candle, and this is the candle that was engulfed. This is our key level. Some people would call it order block, some people would call it supply and demand. We'll keep it simple here so anyone can use it. And it's an engulfing candle. Simply you would go to the 15-minute time frame. So that simple 2 candles formation is actually a market structure shift in its own in the lower time frame. So that's one way of using the 2 concepts, is that at the key level, I want to ensure that that key level actually initiate a market structure range to trade from again. Another way to do it is actually just when price goes higher, I want to see another structure of this range, and then you can be trading based on this lower. So playing the price action, and I can see simply that this is a valid structure already. So it could be simply looking for a confirmation here. Now confirmation is, you could be looking for an engulfing candle, or you could be looking for an alignment. So for this one, just a simple candle aligning with a key level, that is, could be an entry for me, okay, and targeting maybe 2 to 1, 3 to 1. So randomly taking this, playing the price action, not actually a valid structure, but price pushing lower, you could be looking for the continuation from this range as well again. And then notice how again we have another one. So now this is a valid structure happening off here. So could be looking for the continuation because this is coming off a valid key level. However, switching to the low time frame, now price is going down to the target, but one thing that we notice happening is that we actually have another engulfing candle. So notice how this is a retracement to the upside, engulfing candle, marking this as my engulfing, and then we could also look for the confirmation of here and making sure that this actually have a valid structure, which we already saw here, is that yeah, this is actually a valid structure. And you notice how price did not go there yet, but getting very close to it. We could be using this as liquidity, which is a good concept to understand. We're not going to be focusing on every high or low, but once that matters. So now price gets close to the key level that we had, which is the engulfing candle. We go to 15-minute time frame. And simply the moment price goes there, we could be, or whenever we have an alignment, we could be entering. So playing the price action, we'll notice price going there. For me, this is an alignment, even though it's a bit weak. So if you want to enter based on this, you need to cover, have a bit of a bigger stop loss. So you could be doing this just based on the alignment, and then a stop loss here, because I think price could go back up there. You could be entering based on this engulfing candle. So another entry that is more safe, and then targeting the low again. In the price action, that's where price goes to aggressively and immediately. in this case, we do not have the best structure, but here we do have a breakout structure and we're trading actually with a structure going lower. So this setup is more safe than this, because this one we only take based on a key level, but this one is a key level on the higher time frame and also structure on the higher time frame and the lower time frame. Now, if you're using 3 time frames, then it's gonna be a bit different, because now you'll be using the key level on the higher time frame, and then you want to look for a structure created of that key level, and this is the structure that you'll be looking for and to trade the continuation from. Not every structure, because sometimes I'll be seeing a breakout structure, but then there's not going to be a continuation from it. What's the reason? This one here might not be happening off a key level, for example, on the higher time frame, but this one might be happening off a higher time frame, and that's why we had a continuation lower. I can see that we do have a breakout structure happening here, but then it did not work. But then we do have kind of a structure going lower here, not the best one for me. But then as we go lower, we have another breakout structure. Now this one is strong one. Now you want to be looking for, and in this case, you want to see, is this structure happening off a higher time frame key level? Because if it's happening, and when I say key level, it could be anything. So this is a question that you'll be answering based on your key levels and based on your trading plan. So if this makes sense for me and it's reacting off a higher time frame key level, then what I'll do is look for the continuation lower, because this is a strong range here. Now, for example, we go to 4-hour time frame, and let's say you're using imbalances, and you would notice that, okay, I'm actually having an imbalance here where price actually reacted from. So this could be, and you could go here 15-minute or 5-minute. Now on the 5-minute, there was something more specific. And to be clear, it could be sometime, it's not like 1 hour, you should always do the 5-minute. You could be flexible, sometime doing 15-minute and sometime even 1 minute. So feel free to be a bit more flexible depending on the situations. In this case, we can see that 5-minute actually give this weakness and then breakout structure. So you could simply look for the continuation of this range. The reason is simply because this came off a higher time frame key level. So it could be selling from here, anywhere inside of this range. And it could be also doing 15-minute and look for example, this imbalance here. And then you want to have a stop loss above and target somewhere in here, because this is a whole 4-hour range. So we do have this 4-hour breakout structure going lower, and then we might be having another breakout structure. So this is how it goes. Okay. Now it gets you here, and then notice how what the 4-hour does. Now in this case, it does not go to the take profit, okay, but it gave around 8-1. So this is still valid, and notice how basically because you're trading off a higher time frame key level, that structure on the 15-minute is valid now. So what validates the structure is actually the higher time frame key level. So this is what we see. A lot of time we see this happening, price going lower, and then we have a breakout structure. What will happen is a continuation down. And then sometime we do have this, but it's a continuation up. The main difference is that here, we might not have the best key level, but in this case, here we had the best key level. And that's where we had the real push to the upside. And that's where the real change in the market structure was happening. So in order to validate the structure, we use a higher time frame key level. That's how you can be, using 3 time frames, but when you're using 2 time frames, you could be simply trading this here that had a key level. So you could be simply looking for the structure that for you is valid, okay, without the key level, without anything here, but simply a structure that is valid, a key level that is inside of it that is also valid, and simply you'll be looking for the confirmation just right here. So that's it for today's video, a very simple one. If you have questions, leave them in the comments. Make sure to check out H-School if you want to learn my high reward to risk trading setup and you want to trade with me. That's it, and I'll see you next one. Bye-bye.